good news is good news unless. Could you kind of give some, I guess, clarity on what exactly you mean by unless? What does that entail?
The good news is really towards the economic numbers that are coming in, and that there is or was a lot of expectations. In particular, the inflation rate is coming down, and as we could see, the inflation rates were coming down in many different parts of the world, also in the US. But at some point, you always have, or you should ask yourself, so what is the underlying? Why is it coming down? And is there anything in the economy, anything in the numbers that makes this number, which might look good, be a bad outcome or a bad news? So, for example, we saw it in China. China had also higher inflation. Inflation was coming down, moving into deflation, which is certainly not a good thing. And so in the US, we have the same in a way, not that we are expecting that they move into deflation, but we have the
Certainly.
underlying economy that maybe is not doing so well. And that's the reason why inflation numbers are coming down.
Yeah, in terms of what they're spending. And I think the whole play on the words of good news is good news comes from the old additive bad news is good news is no news, and no news is good news. So kind of that play on looking at the markets, and
Yeah.
and so that's I think what we were trying to, or you were trying to really express in that was taking these old additives of the markets and trying to understand, trying to build a picture. I mean, especially in the data in terms of what is the good news, as you
Mm.
said, the inflation, but also they had backward revisions on the jobs being created. They had, in the U.S., excuse me, unemployment numbers had to be revised, and so there's this trend down in inflation, but up in unemployment, in job creation. That's also trending down as it had been showing strong numbers. So I think it kind of really shows, I guess, there's an economic predicament. And that
Yeah.
kind of pulls us into what we want to talk about next, and that is the inverted yield curve. Why has it taken so long to materialize? Often it says when that inverts, then there's going to be a recession in whatever, 12, 18 months, there's a recession. We haven't seen that in the US. Could you
Mm.
give some context to that?
Yeah, surely the inverted yield curve is usually a forecast, like it is based on the expectations of the market investors, let's say, especially in the fixed income area. So maybe to start with, what the inverted yield curve means is you oftentimes have longer term interest rates are higher than the short term because there's more insecurity. And if it is inverted, it means that the short term yields or returns on fixed income instruments are higher than the long term. So you don't really get a return for the liquidity premium, which then would be kind of negative. And so the inverted yield curve usually is not a direct correlation that today the yield curve turns inverted into the inverted area, and then you have a recession. Usually, it takes quite some time. If you look back in history, sometimes or in one situation, it took up to over 700 days, and now we are 2 years ago when it started to be inverted, and so we will see whether now, since it has moved out of the inverted area, that we will now see the recession coming in.
Well, and looking at that today, it's right at moving out. It seems that it's
Right.
still a little bit inverted, but again, kind of like the trend of inflation, it's trending towards that level. So, what does that, I guess, mean from your how you view it? What does that mean for the economy in the U.S.? I mean, as we see that if there's higher yields at the short term, there's probably more insecurity in the markets, and they think there's probably a recession coming. And if it's higher in the long term, it's like, hey, things are really good for a while. We the short term we're not so worried about. The long term that we see hitting that we're a little bit, uh, I guess, not are planning for. What do you see in terms of the economy there?
I mean, for the economy, it always comes down to how especially the companies deal with that, and also when it comes to the mortgage rates. Since in the U.S. they are up to 30 years, while in European countries they are oftentimes much shorter than that. And so far, it has been cheaper to have a long-term yielding debt to issue, and now you have to think about, okay, what is a good time frame, time horizon to issue new debt, and what does it mean also for existing debt when like the long-term yields are coming down, meaning that it becomes more expensive again.
Yeah. So on that, we're looking at the U.S. We often, I mean, as investors investing outside of the U.S., with I guess our portfolios referencing the U.S. dollar, we're looking at the value of the U.S. dollar daily, seeing where it's moving. Um, we did see, I guess, a weakening of the U.S. dollar. In the newsletter. You kind of expected, I guess, an uptick or a rebound in that. What have we seen there? I mean, we've seen a little bit of an uptick, but where do we see it kind of moving forward?
Yeah, so the interesting thing there is that with the expectations that the Fed or the Federal Reserve will decrease interest rates, they have quite a bit of impact or influence on the value of the US dollar
Mm.
uh, compared to other currencies. So the expectation is clearly that the US dollar will loosen further value. But as I mentioned at the beginning, with the good news is good news unless it's like when there is some kind of a market or major market event like a liquidity crisis, financial crisis, some crash at the markets, as we, for example, have also seen in Japan
Yep.
recently, that there could that this could lead to a demand of the US dollar, even though the interest rates are falling.
Hmm.
And so the long-term trend is, from our perspective, still intact, that the US dollar will lose more and more value towards other currencies, or many other currencies, not all of them,
Sure.
obviously, because there are so many. Uh, but that in the short term, there could be quite some volatility in there. And we have also seen last year at the fourth quarter of 2023, the US dollar index lost quite some value.
Yep.
Then it has recovered, and now it is losing again. And we find ourselves already at a lower level than what we have seen in December last year.
Yeah, and I think that's something that's always valuable when looking at setting up a portfolio or looking at diversifying outside of your home currency is what will the currency exchange rate do. I mean, every basic bachelor's study economist or someone studying economics or finance will learn about transaction risk or a translation risk, and often, at least studying in the US, it was always spoken about in a negative sense. Now, they
Mm.
did mention, oh yeah, you can get positive gains in some currencies, but never really talked about that long-term effect. And I think that's something that's interesting of when you're positioning in the long term against the US dollar and saying, okay, we're not hedging, we're not saying
Mm.
let's buy a price, let's fix a price and exchange it. We're just saying, hey, look, we want to position against the long-term distance of the or value of the US dollar. You see incredible amounts of appreciation in certain currencies against the US dollar that if you're then investing, either add or reduce volatility to your investment portfolio. And I think that's something that a lot of people miss sometimes, and kind of why we even talk about these subjects in general, why we put this newsletter out to bring I guess a holistic view of the global economy.
Yeah.
And I think that's really valuable. Now we do want to touch on one little kind of last point, and that's what's on the front of everybody's minds is what will the Fed do this month with their interest rate decision? Where do you see it heading, and how much effect do you think it will have on the US dollar's value?
Yeah. So I briefly mentioned the crash in Japan just before, and it was interesting. It also impacted other markets, also the U.S. markets, which corrected. And at that time, there were some investors coming out saying, "Oh, the Fed should cut the rates right now because there is too much danger in the
Yeah.
markets, and they really need to do something about that." And after that, we had the Jackson Hole meeting where president of the Fed, Jerome Powell, gave some hint that, yeah, we're ready to cut. So the pressure is really, really high to cut. So I don't think that there is really something out there which will prevent them from cutting rates. So the
Yeah.
question rather is, how much will they cut? Will they cut 25 basis points? Will they cut 50 basis points? I don't think it will be more than 50 basis points, but I could imagine that 25 basis points it could be. So that would make most of sense to me, because it doesn't look really, really bad for the US at the moment. And if they do 50 basis points, it would show some kind of panic to me to say, okay, we waited too long. Maybe they did wait too long to cut rates. That could be, but they should be keen to bring some stability into the markets and saying, look, we have everything under control. So we cut by 25 basis points. Maybe they do another 25 basis point cuts in October, and so splitting it up over the time. And if they manage to bring some stability back into the markets, I could imagine that it will further reduce the value of the US dollar, because that's what usually happens, because the opportunity costs become less, and so the demand for US dollar will decrease. But if they show panic, then I could imagine that there will be some kind of sell-off, and which will then strengthen the US dollar and lead to this in-between strengths I mentioned also in the newsletter.
Which I think is fun. It's an interesting picture to build.
Yes.
If it's a stable kind of everything is going all right, then we kind of would see the weakening of the U.S. dollar. If it's panic, people are we want the U.S. dollar, which might seem a little bit counterintuitive, but when you really look at it, a lot of the price or the value for the U.S. dollar is in the demand, and currently there is a lot of demand in the U.S. dollar. I mean, tons of U.S. dollars are sitting in CDs or treasury, high-end treasury yields because of the high interest rate in the U.S. So that's where you kind of see it make sense. Okay, this money will be taken, more of this money will be taken away. Okay, there's less demand for U.S. dollar, the value goes down, as opposed to panic. Oh, I need my US dollar. That's going to be us for this week. For those viewers looking to follow our newsletter, in 3 weeks, we're going to release the new newsletter. So you can sign up in the description below to get that directly to your email. And then we will be back here 6 weeks from now to discuss how things have progressed.